Right, so we're talking about a company that basically said, you know what, this whole software thing, it's fine, but what if we just bought a lot of Bitcoin?
Pretty much. Strategy, which was MicroStrategy, formally rebranded in early 2025. They are the world's largest corporate Bitcoin treasury. They pivoted almost entirely from their enterprise analytics software, which, brought in a respectable $450 to $500 million annually, to just aggressively stocking Bitcoin as their main reserve asset since 2020.
So they went from let's help businesses analyze data to let's just acquire all the digital gold. That's a pivot, all right. How much are we talking here?
As of early January 2026, they held 673,783 BTC. Their average cost, around $75,026 per coin, for a total cost basis of about $50.6 billion. And at the time, that was valued at over $63 billion.
$63 billion. That's not pocket change. And this is all thanks to their executive chairman, Michael Saylor, positioning Bitcoin as superior digital gold, and then using all the corporate finance tools he could find to just max out their exposure.
Precisely. It's created one of the most innovative and, let's be honest, controversial leveraged investment vehicles in modern markets. It's essentially a giant Bitcoin proxy, but on steroids.
Steroids indeed. And this whole thing is powered by what they call the flywheel mechanism, which sounds like something Wile E. Coyote would invent if he was into crypto.
It's a self-reinforcing cycle of leverage and accumulation. Bitcoin price goes up, Strategy's net asset value, which is mostly Bitcoin, goes up. Then the MSTR stock often trades at a premium to that NAV, historically 50 to 100% in bull markets. That premium lets them raise cheap capital.
So people see the stock doing well, they're willing to buy more of it, even at a premium, which gives the company money to buy more Bitcoin. It's like a financial Ouroboros, eating its own tail but getting fatter with every bite.
Exactly. They issue equity, convertible senior notes, preferred stocks. They take that money, buy more Bitcoin, which increases the Bitcoin per share, and boosts the NAV and stock price further, attracting more capital, and the cycle just repeats. The convertible notes are key. They borrow at minimal cost, sometimes 0%, with call options on their own stock built in.
And they're not shy about their ambition either. There's this 42-42 plan, aiming for $84 billion total, split evenly between equity and fixed income by around 2027. It sounds incredibly effective in an uptrend, but what happens when the flywheel gets a flat tire?
That's the flip side. A stall in Bitcoin's appreciation or capital markets closing up could halt the whole thing, potentially leading to dilution, deferred obligations, or worse. They've also diversified their funding with a layered capital stock, including perpetual preferred stocks like STRK, STRF, STRD, and STRC, each with different dividends and risk profiles.
So they have Strike, Strife, Stride, and Stretch. Sounds like a corporate cheerleading squad for Bitcoin. These preferred stocks come with high yields, 8 to 11%, which definitely attracts income investors.
They do, but their sustainability relies entirely on continued inflows in Bitcoin's growth. Luckily, they had a $2.25 billion cash reserve as of early 2026, which acts as a buffer for about 12 to 24 months of dividends and interest payments. Still, the whole structure has drawn some comparisons to a Ponzi scheme, at least superficially.
The P word. I knew we'd get there. The reliance on new money to pay old money, continuous capital raises to fund Bitcoin buys and dividends, the whole perpetual asset appreciation thing. It definitely has some echoes.
It absolutely does. New issuances essentially benefit Bitcoin stacking at the expense of existing shareholders through dilution. And if that reflexive loop of enthusiasm raises and more Bitcoin reverses, things could collapse when inflows slow down.
So if it walks like a duck and quacks like a duck, but the source material is pretty clear here, it's not a Ponzi. What are the key differences?
Crucial differences. Firstly, transparency and regulation. Everything is disclosed in SEC filings, earnings calls, public purchases, no secrecy. Secondly, it has a real, liquid underlying asset. Bitcoin is independently valued, tradable, and verifiable. No one's promising fixed, guaranteed returns here. They explicitly warn it's a high-risk, speculative bet. And finally, it's all standard corporate finance. Leverage via convertibles and preferreds mirrors what REITs, banks, or leveraged ETFs do. It's financial engineering, not fraud.
It's like saying a really aggressive hedge fund is a Ponzi because it relies on capital inflows and asset appreciation. It's just a different level of risk and transparency. What about if the stock trades below its actual Bitcoin value? Can they sell?
That's the below NAV scenario. The company's market cap did trade at a discount to its net asset value multiple times in 2025-2026. Filings and executive statements indicate that if MSTR trades persistently below 1x NAV and capital markets close, then selling portions of Bitcoin becomes a last resort to service obligations. Management has called it mathematically justified in extreme cases.
So their never sell philosophy has an asterisk big enough to see from space.
Become a real possibility. Their cash reserves definitely help mitigate near-term pressure.
So to wrap this up, the big question, is strategy a Ponzi scheme? The answer is a firm no, according to the analysis we're looking at today. It's a highly leveraged, transparent, regulated corporate structure acting as an amplified Bitcoin proxy.
It is. The flywheel mechanism creates those Ponzi-like dependencies on new capital and Bitcoin appreciation. But it's backed by real marketable assets, full disclosures, and voluntary participation. Success is absolutely tied to Bitcoin's long-term trajectory. In a bull market, you get those outsized returns. In a prolonged bear, you're looking at potential massive dilution, dividend deferrals, or even forced Bitcoin sales.
It's a bold, high-risk innovation, definitely treated as speculative exposure, not a safe play. If you found this wild financial ride as fascinating as we did, tell a friend about this episode.